And with that said, let's dive into getting ready for the next market downturn. So, um, at least for me in my world, maybe some of you're not hearing much about the next market correction or a downturn coming. We all listen to different news and pay attention to different things and operate in different circles. So, I know for me, I feel like I've been hearing about this next market correction for a long time. This has been something that we've expected for a while to happen, and it hasn't. This has been the second longest bull market, growing market in history. And I think it's around Q. If we do not have a correction here in the next few months, it'll be the longest in history. So when that happens and the market keeps improving and keeps growing, it makes it sometimes feel like it could continue forever, right? There's lots of good things to be happy about, and maybe there won't be a major correction, major decline, a recessionary environment. But I'm here to tell you, I don't have a crystal ball. I can't tell you the exact day it's going to happen, but it is going to happen. 100% chance there will be a major market correction coming in the near future. The stock market will go through a major decline. Home values will decline again. Most asset classes will have some major disruptions. It's going to happen. It may be end of this year, maybe 2019, and maybe 2020. Who knows? Maybe it'll go all the way to 2021. I don't think that's likely, but maybe. But at some point in the foreseeable future, there will be a major disruption in the financial markets, and the value of most investments will decline. In many cases, will decline pretty rapidly and significantly. So the question is, how do you protect your wealth against a market correction? But also, and this is, maybe for some people, that's all that you're concerned of is just how do I protect my wealth, right? And if that is your sole concern, that's a big concern. But if that's your sole concern, your decision making and preparing for the next market correction might be a little bit different than if you also want to make sure you're able to take advantage of the next market correction and be able to earn solid returns. So if you just say, look, I just want to make sure I don't lose anything. I want to protect my wealth. That's a little bit slightly easier of a formula than if you say, not only do I want to make sure I don't lose money, but that I'm also positioned to capitalize on all the opportunities that'll be here in a recessionary environment. And those are, for us here at DLP, we're concerned with both. So in order for you to ask yourself this question, and then I'm going to get into how we look at it and what we're doing, you need to ask yourself or think about what are your goals or needs in your investments. So, over, say, the next 6 to 10 years, and I say 6 to 10 years because if we go into a market recession, say, in the next 2 years, we just went through, it was about a 6-year declining market and now an 8-year improving market. So looking at it from start to finish, typical market cycles usually are 6 or 7 years, but we've seen them get longer and longer. So it could take from today through when we go into recession and finally, come out through it in our strong market, could be up to 10 years. So thinking about from now through till we get to the next, growing cycle, the next improving market, in thinking about that timetable, how important are distributions going to be? How important is income going to be to you over the next 6 to 10 years? I think is a critical question to ask yourself. If income and consistent distributions is really important today or is going to be important over the next 6 to 10 years, that may adjust how you think about your investments and where you want to place your capital. You might want to really make sure you're in investments that have a high probability of producing, consistent income. And if consistent income is important to you, how much do you need? You should be able to somewhat work backwards from where you expect your income or distribution needs to be, thinking about how much of your assets need to be in assets that are able to produce consistent income. And then how important is liquidity going to be to you? How important is it that you're able to take your money out of the investment vehicles you're into, to have access to that capital for whatever reason, good or bad? Meaning good, you want to be able to capitalize on opportunities, or B, you just want to be concerned on a rainy day. You might need the money, or you have life things coming up. You have major expenses coming up, or college for your kids, or whatever the case, certain obligations that you want to make sure you have the liquidity to handle. To me, liquidity and income over the next 6 to 10 years are really important questions to think about in how you structure your investments. And then the next question is, what is your investment horizon? So I mentioned, there's going to be a market cycle could take 6 to 10 years to go through the next decline and back through. You're thinking of, if we were sitting here today, if it was 2005 that we were sitting in today, which you could argue there's certainly a number of characteristics that are very similar about today's market as 2005 or 2006, and saying, all right, I'm going to have to weather this through back to we get to 2015 or 16 or 17, where the market was really strong again. What is your horizon? Is the next 5 years, is growth really important to you? Are you concerned with your investments growing the most in the next 5 years, the next 10 years? Are you saying, look, I'm not retiring for another 20 years. I'm really not worried about the next 5 years or 6 years or 10 years. I'm most concerned with the next 20 years. If you have the luxury or the advantage of having a much longer or broader horizon to think about, that can make a significant difference to how much really the next cycle matters to you and how much it's really going to affect you. With I sort of say one caveat to that is that even if you were somebody who says, I have a 20-year horizon, I don't need the money, I'm not going to touch it in the next 10 years, I don't care if my value of my assets goes down because, I'm just looking at it over the next 20 years. That sounds well and good, and that's a great position to be in. But I would ask you to really consider, how strong is your, what I call your investment willpower. And what I mean by that is when all of a sudden your investments are declining and the value on your statements, your Charles Schwab statement or whatever the case, is going down, and you went from 500,000 to 400,000 on that statement, and then 350,000, and then 310,000. You're seeing that kind of decline month over month or quarter over quarter. How much staying power, how much willpower are you going to have? Are you really going to be willing to endure and ignore and just stick those statements in a drawer and not let it bother you? Or are you going to do what most people did through the last downturn, and what most people do in most of these market situations is they exit at the low point. They lose 20, 30, 40%. They get tired of losing. They get tired of their advisor telling them just to wait it out, and they cash in. And they cash in, really works out to be the worst time at a low point in the market, because they're too worried of losing more money, which is a very valid concern. But that's why they say, I've seen stats say the S&P 500 averaged a 12% return over a 30-year period. I think it was 85 2015. But the average investor only actually effectively earned about 2% because they entered the market at high points and exited at low points. And that's very common. So I would encourage you to think about that as you think about how you're going to be positioned for the next market change. All right, so those are some questions I think any individual investor should be thinking about, should be asking, and are sort of some of the guiding questions to what DLP is thinking about, what I'm thinking about, and how we're preparing for the next market correction. So first and foremost, for us, it's keeping our investment rules or principles, front and center in our decision making. I'm going to grab a sip of water there. So that means no losses and consistent returns. So that's really, really important for us. We don't have, I guess you say, the luxury or the flexibility or the willingness to suffer losses, and to go through situations of having to have write-offs, having to report losses to our investors, and having people actually lose their money. It's not an option for us in how we make decisions and how we look at investments. And then for us, we know it's really, really critical to our investors and to us that we're generating returns that are very consistent, income that investors can count on. So with those principles front and center, that guides us into how we're thinking about things. So one of the key parts of being prepared to capitalize on the next market correction is being prepared. So we're doing things right now like locking in our interest rates and financing on our properties. So completing our refinances on properties, getting fixed interest rates locked in for the next 10 or 12 years so that we're not going to have interest rate spikes on us over the course of our loan, or get a loan called on us that we have to pay off at the wrong time. So we're focusing hard on the financing side right now in preparation. Another thing that's really important for us, and that's, you could say, is one of the reasons for doing a webinar like this right now, is setting the right expectations and structure with our investors, so that our investors are on the same page as us, and our investment is structured the right way to be positioned to not have to exit a property, as an example, at a low point in the market, and have to give up a lot of the return because we're in a position where we need to sell at the wrong time, as an example. Our ultimate goal here is simple. It's to mitigate risk, not allow losses, and be able to capitalize on the opportunities that are going to be in front of us. So, even though, talking about a recession, talking about a market correction is not a fun topic, even though we don't want it to happen because it's going to negatively affect so many people. For us as an investment firm, we know that there's going to be unbelievable opportunities when the market corrects. Back in 2012, 13, 14, the opportunities were just incredible. And we just wish we could have bought more at that time. We could have invested more at that time. And we know that 2012, 2013 timeframe is going to be here again. And we want to make sure we're prepared to capitalize on that. So some of the things we're doing and how we're thinking about investing to prepare for knowing this correction is going to come in the near future is making sure we're investing in income-producing assets. So we're really focused on, and we've been focused on two main types of investments. But as we prepare for the next change in the market here, we want to make sure we really drive our multifamily portfolio, drive stabilization. We really want to make sure we have a very stabilized portfolio producing really, really consistent returns. We're working really hard right now of getting our recently acquired property stabilized and performing, so that we have great consistent cash flow coming. We're all of the other side of our business, the lending side of our business. One of the great things of that business is all of our loans produce monthly income, monthly interest payments from our borrowers. So focusing on making loans that require monthly interest payments, so the day our money goes out on a loan, we're earning interest that very same day, and every day the money out is a great way for us to make sure we have consistency in income. So those are the two strategies we've been focused on, and we're sort of doubling down on our focus and really driving stabilization of our multifamily properties, driving up occupancy, driving through all the renovations, so we're producing really, really great cash flow. Another big focus of ours is liquidity. So I believe liquidity is incredibly critical to be able to weather market changes and not be forced to exit illiquid assets. So we don't want to be forced to have to sell an illiquid asset that we'll have to take a major discount due to the illiquid nature of that asset. So, meaning we don't want to have to sell an apartment community when the market's really soft and there's less investor capital out there to buy those properties, as an example. Liquidity provides us with buying power and the ability to capitalize when the financial markets are tight. So when nobody wants to lend and when people don't want to invest, when everybody's afraid, is when prices go down, which is why we don't want to be forced to sell at those times. We want to be in the position to be able to buy, capitalize on the fact that nobody else is buying. The greatest wealth is built in recessionary environments. There's so many amazing lessons you can find endless number of lessons just from, one investor in a Warren Buffett, as an example of really capitalizing. And, he was out there bailing out these banking institutions on just unbelievable investments for him and for Berkshire Hathaway's when nobody else wanted to touch them. And being able to be in that position because he had the liquidity, the cash to do so when most did not. So that's why we love our evergreen type funds, our lending funds, the DLP lending fund, the income and growth fund, the fixed fund. They all provide liquidity. So they provide liquidity to our investors in that we have 90-day redemption periods for investors, but they provide liquidity to us in that all of our loans are short-term loans. Our average loan pays off in under 9 months. So meaning we have lots of our capital coming back to us consistently, providing us with liquidity, not locking up all of our money into long-term illiquid assets. These are short-term loans that pay off very quickly. So we're really focusing and driving more of our focus, more of our assets into these liquid funds so that we're better prepared to then jump on moving that money into acquiring properties, when the opportunities are tremendous. Another thing that we're really starting to do, and you'll hear more about this from us if you're an existing investor, but also if you're paying attention to us, thinking about investing with us, is selling and exiting assets that we think will have exposure during the next downturn. So we think that single-family homes will decline in value, the exit of being able to sell single-family homes to home buyers is going to be a lot softer when home values start declining and mortgage requirements tighten and so forth. So we're right now selling off nearly all of our single-family rentals. We've sold off about 50 in the last 90 days, and over the next 6 months or so, we expect we'll sell off 95. We'll have sold off over 95% of our single-family rentals. So we don't think they're great assets to hold long term. They don't produce the same income and consistency in distributions as multifamily assets. And then we're also selling off some of our multifamily assets that we think will become more illiquid and that we don't want to own long term. So again, back to a point we made earlier, that likely you're going to have to look at being in a position that this next market cycle can be 6 to 10 years. We're looking at some of our assets saying, well, we don't want to be stuck owning these properties for the next 6 to 10 years, and we don't think we'll be able to sell them for their full value in a recessionary environment. So we're exiting a lot of our smaller multifamily properties, some of our C-class communities, because we think that those assets are going to become illiquid first. The financial markets, investors are going to move away from those assets. And even though the supply and demand is great, and we know we can continue to rent those properties, we think occupancy will remain great, and rents are going to be really strong, and they'll produce good income. We're going to be put in a really illiquid situation on those properties. And we want more flexibility to be more liquid, as we just talked about, so we can capitalize on a lot of amazing opportunities that are going to be available. So we're selling a lot of our smaller, lower quality assets so that we can have our money, A, more liquid, and B, have our assets in properties that we think are going to better weather the downturn from an investment standpoint, and won't be as illiquid. To explain what we're doing in a little more detail, especially for new investors, we have 3 different funds right now that we're operating that we think are all extremely well positioned for the next market downturn here. The first is the Income and Growth Fund here, which you can see, and the second is the Lending Fund. These 2 funds are very, very, very similar. So you'll see 10% preferred return, 11% return target, 90-day liquidity. Exact same structure of these 2 funds and how they're operating. On your screen here, you see the DLP Lending Fund. I just noticed that it says initial 1-year commitment. That's actually not accurate. We've removed our 1-year initial commitment. So what that means is if you invest in this fund, you can redeem your investment in just 90 days from day one. We distribute all of the income every month. You can compound that income. We pay at a preferred return of 10%, meaning you earn 10% before we earn anything, and we have an overall return goal of 11%. We've averaged a little over 14% return net to investors over the last 5 years. Our loans are first position loans, an average loan to value of under 55% to experienced investors. Again, our average loan pays off in under 9 months. So very liquid, which is a big deal to us, and we think to be to most investors in the next changing market. And again, you can see Income and Growth Fund is very, very similar. And then if you say, well, Don, this sounds great, but I'm not really concerned as much with growth. I'm really concerned with losing money. I do not want to lose money. I want to make sure I'm in the best position to avoid any losses. Well, our note offering is our lowest risk investment option, where you can commit your investment for as short as 90 days. So you can lock up your money for just 90 days, have a lot of liquidity, or you can commit longer, especially if you're saying, look, I want to make sure I have consistent income for the next 5 years. I want to know I can count on it. That's the biggest driver for me. This could be a great option for you to consider. So you can lock in for 90 days, 3 years, or 5 years. And then based on the amount of money you invest here and the term you choose, you get a fixed return for your entire investment. You'll know exactly how much you're going to earn. It'll get paid out to you every month, or you can let it compound and grow. It's going to give you great consistent income. It's going to put you in the lowest risk position of any DLP investment. We believe an extremely low risk position is our viewpoint. And if you want liquidity, you can lock in for just 90 days. So we think a really, really great place to be to mitigate risk. And then the last option we have, and all of those options I described are all within our lending strategy. different ways you can invest within our lending strategy. The other way you can invest is in our preferred return equity fund. This is our fund that owns real estate. So everything I just talked about, those funds make loans against real estate. This fund owns real estate. So the fund has a 5 to 8 year investment time frame. So the reason it's 5 to 8 years is because we want to make sure that we're not rushing to exit the fund in year 5 or 6 if the market's not very strong. So that's why we have the option of keeping the fund open as long as 8 years. We think that'll put us in a position to be able to take more time if needed, to be able to maximize everybody's investments. The goal is for us to distribute out 8% distributions on an annual basis, so paid out quarterly. So in other words, you invest $500,000. Our goal is to distribute to you $10,000 every quarter or more, very consistently. And then at the end of the fund, in year 5, 6, 7, 8, when we sell the properties, our goal is to return back to you 1.5 to 2 times your original investment, making your overall return at least 12%. And in this fund, you can redeem your investment in 180-day notice. So not as liquid as the other options, but still has a layer of liquidity there, and will provide you with a great place to earn consistent returns and be positioned to be able to weather the changing market. I will mention, I know this fund here says a $500,000 minimum for any of existing investors, and if you're a potential new investor, we look at any investment minimum as our overall account size, so you can split that up across multiple different investment strategies, and we can always work with you there as well. So this is a little different. This is less liquid, but it's going to give you great income. It's also going to help you to defer all of the income you earn from tax and be in a strategy that's really well positioned to weather the storm, as we're investing in Class B apartment communities that are going to produce really good income. Rents are going to remain strong. Occupancy is going to remain strong. And we should see income growing each year, even if the market's crashing around us, which is a pretty great place to be. All right, so that's a lot of information, especially if you haven't heard it before. Appreciate everybody staying on with me. I'm going to open it up to questions. Every time I try to allow verbal questions, somebody's got their TV on or conversation going on. So I've been advised by my marketing team to stop doing that. So I'm going to just ask you to type in any questions in the chat box there, which some of you have already done. So again, there's a little chat box. Please feel free to type questions in there, and I'll go ahead and start answering them now. And as you type them in, I'll address them. So, all right. So first question. The first question kind of goes in what I just talked about. What makes you so confident in owning apartment communities when the market crashes? Yeah, great question. So as per this last slide here, this fund is our fund that's buying apartment communities. It's our third fund doing this. And in this fund, we're focused on buying Class B apartment communities. These are non-luxury apartment communities, average rents in the 800 range per month. And what's so great about this space is that all of the new supply being put out in the market, being built, is all Class A. It's all luxury. In this Class B market, there's no new supply. There's no new product being built. You can't build an $800 a month apartment. So there's no new supply coming, but most of the jobs only support the kind of incomes that can afford an $800 a month rent instead of a $1,500 a month rent. So we think when there's a market correction and people are losing jobs or having to take jobs with lower incomes, et cetera, people are going to be forced to live in affordable, safe, nice neighborhoods versus living in luxury, beautiful communities they might be stretching themselves to afford today. So we think when the market changes, more people are going to move to the B space. And even without that benefit, right now we're investing in markets with strong population growth, strong job growth. So even without people moving from the luxury space into the affordable space, and also people going from being homeowners to renters, which is something that always happens in a market downturn, we're going to have really strong occupancy, really high demand. And even if you look back to 2007, 2008, 2009, 2010, 2011, rents in this Class B space went up throughout that period in almost every market in the country, even when we were going through arguably the greatest recession in history. So we think we'll be in a great position to be able to produce phenomenal income. Real estate won't be as liquid to be able to get out, and you wouldn't want to exit and sell everything off at the bottom of the market, of course. but to be able to continue to produce great income, we're really, really confident in this Class B strategy. All right, next question. Will you be starting a new fund that will be an equity fund that will take advantage of the next downturn? Yes, that's a good question. So right now, these three funds that I just talked about, the lending fund, the income and growth fund, and the preferred return equity fund, lending fund and income and growth fund are both what's called evergreen funds, meaning the funds are going to be open indefinitely, and we expect to continue to grow and have people invest in those funds right through the downturn. And I think they're going to remain a phenomenal place to invest and a phenomenal strategy for us. The preferred return equity fund, the fund that I have the screen on right now, this fund's only going to be available for investors to invest in for about the next year, and then it'll be closed to new investors. We may open another new fund in a year from now, depending on where we're at with market conditioning. We may open a sort of fourth equity fund after this one that's specifically focused on buying distressed assets and capitalizing on that downturn. But we are really convinced that investing in the Class B space is going to remain the core of our focus as an owner, as an operator, and short-term bridge financing is our main focus as a lender, and we think a phenomenal place to be as we're preparing for the next downturn. And then when we're in the middle of the next downturn and there's amazing opportunities to invest, we may see more capital going into strategies to buy properties versus lend on properties because there's such amazing opportunities to buy. So that's a great question. Somebody just typed in that they lost my audio. On my end, it looks like it's working. Can somebody else type in if they had a hard time or if they can hear me well? Okay, thank you. So I'm not sure who it was. All right. So next question was: do we see ourselves investing in Class A properties in the future, and opening a new fund to compete against other Class A properties? So Class A properties are if you're driving through any neighborhood, the beautiful or any market, you see beautiful, gorgeous new communities being built that a lot of times almost look like condo communities anymore. Those are your Class A communities, really nice, really, really amazing amenities, lifestyle type properties. And I'll tell you, I would happily buy Class A properties today if you could buy them at the right pricing, and that's the problem. The cost of constructing them is so high that and the demand for them is so high that they're often selling at a 4 to a 5 cap rate, meaning that that if you were to have it own the property all cash, you'd only get a 4 or 5% return, gross return on your investment. So when the market goes through a major correction and there's a lot less people investing and people move away from investing in the asset class, there may be amazing opportunities where we can buy luxury or Class A properties at much lower prices. And if we could buy Class A at much lower prices, that we could weather changes in the market, that we could take lower rents if we had to, if the market was going through challenges, in markets without oversupply, we would consider Class A at that point. But and that's an example of one of the amazing types of opportunities that may really be there in a heavily distressed market in the future. It's a great question. Next question here is: what if home values drop, and how will that affect the loans you have made? That's a good question. So I would first start off by saying it's not if home values are going to drop; they will drop. I think they will drop pretty heavily in a lot of markets, and you may see 20-30% drops in home prices in a lot of markets when over the next few years. And so one of the great things about our lending strategy is, first of all, our average loan is only 55% loan to value. So do I think property values are going to drop 45% in most markets? No. Are they going to drop 45% in 6 to 12 months? Absolutely not. So we're in because we're making short-term loans and there's so much equity, it puts us in a really, really great position. That if we were making 10-year loans or 30-year loans, and you're making traditional 80% loan to value type loans or 90% loan to value like some lenders, yeah, you're going to be in a situation where you could be upside down and have more lent out than the value of the underlying asset, which is not a good place to be. But because of our short-term nature of our loans and the low loan to value, we'll be in a really strong position that our investors will be able to liquidate the properties and pay us off. And then also our investors are strong, experienced investors with other assets and with personal guarantees on the properties as well, which can be meaningful in a lot of situations. Next question here. So it's a good question. So Joe said the preferred returns fund has a targeted annual return of 12%, while our last fund, which was called the Equity Fund 2, had an expected return of 17%. What is the difference? So it's a great question. So if you're an investor in the Equity Fund 2 or you looked at it in the past, you're going to notice a couple of things. First, you're going to notice that the targeted distributions there, the distributions from operating income, the cash flow we pay out to you, is exactly the same. I mean, both funds have a goal of distributing 8 to 9% distributions paid out quarterly, and we've achieved our distribution targets, on all of our equity funds. But this fund has a targeted overall return of 12% versus our previous fund had a 17% target. So the reason for that is a couple things. The first reason is simply that we know when we launch this fund that we will be going through a recession environment soon. So we just wanted to be more conservative in preparing for the effects of the next change. As much as I can sit here and tell you a market correction is coming, I can't tell you exactly how hard it's going to hit, exactly when it's going to hit, or how it's going to differ from the last one. But it will come during the course of this investment strategy. So we just wanted to prepare for that and get more conservative in our return targets. How we actually underwrite the properties, meaning the returns that the properties have to achieve in order for us to buy them, has not changed. So we're buying the same type of properties, the same type of returns. We've just gotten even more conservative in how we discount those expected returns to get to our return to our investors. And the second reason we dropped the return target was simply for optics. And as crazy as it sounds, when people hear higher returns, people associate it with higher risk and lower returns. We get tired of explaining how well we feel we mitigate risk and justifying how we're still able to get such a high return. So we decided let's lower the return target and then just exceed investor expectations. So that's what we're set to do, which we've been able to do in all of our funds. So great question, Joe. When the market does inevitably drop in the future and loans become more scarce through your company, do you have a plan B for the lending fund offering? So the question is, if the market crash comes and there's not as many properties to lend to, there's not as many borrowers buying, and there's not the opportunities to lend all of our capital out, what's plan B? So first, I would say, I expect that there will be plenty of opportunities to continue to lend as the market goes through a correction for a lot of reasons, including much of our competition, meaning our competition for lenders, who are highly levered, who have very little equity, and are making what we think are dumb decisions, meaning lending 100% financing on properties, lending to unqualified borrowers, just doing things I don't think are wise. And there's going to be so many lenders out of the business that even though there may be a smaller volume of transactions, there'll be plenty for us to keep us busy. But to answer your question more specifically, if we couldn't lend the money out, we're not going to stretch and take on risk. So if we couldn't make good loans, then there's going to be two options. Either A, we return investors each a pro rata share of their investment. So, for example, we have $5 million sitting there, we can't get it out there. Return everybody a percentage of their investment. Or plan B would be we'd be able to say, look, there's not as many loans out there, but there's lots of opportunities for us to buy properties, and here's an opportunity to move your money over to this equity strategy, and we'd have another option for you to move your money to. So we don't expect to have that challenge, but those would be some of the ways we would handle it if it does happen. What we would do that way before we would take on risk. All right, great question. So this question here is what am I doing personally in preparing for this? So That's a good question. So, myself and DLP are pretty intertwined. So meaning, 90+% of my capital is invested directly in our real estate assets, either in directly owning real estate or in our real estate loans. I'm invested directly in our funds, invested directly alongside the funds, and have the vast majority of my wealth in these strategies, and continuing to do so. I am moving more of my personal capital into lending vehicles right now, and that's because I own such a large volume of real estate. I want to be able to move more of my capital into liquid investments so that I'm prepared to be able to lead forward with acquiring properties and being liquid to do so when there's a market change. And whenever we go into a new investment strategy or tackle a new strategy, I always lead first with my own money. So I don't like to go sell a strategy or an idea before I've tested it and proven it. So I like to be liquid, that I can always jump in and capitalize on an opportunity and prove it first and take the risk per se out of it. So I'm moving heavily, as we're selling properties, I'm taking that money sort of off the table and owning properties and moving it into our lending fund, moving it into our income and growth fund, and our overall lending strategies. To get great phenomenal returns that they provide, but also to give me, liquidity. But again, I would guess probably at everybody in this meeting, I have a higher percentage of my capital in hard real estate assets than anybody else. So that's kind of what I'm doing. And I think, a lot of people think of becoming liquid as you need to put your money into cash. I look at the lending fund and the income and growth fund as not as good as cash in terms of liquidity, but pretty darn close. And I know, we have 90-day or less liquidity there that'll give me the ability to jump on any opportunities. So great question. All right, I think I've answered them all. Anybody else? Any other questions I skipped? I'm scrolling back through the chat boxes, but I think I hit them all. All right, going once, going twice. All right, no more questions. So I appreciate everybody. Thanks for all the time. We did record this, and we'll shoot it out. Everybody wanted to didn't catch something or came on late, and appreciate everybody's time. Hope to see you at our October 18th dinner in Pennsylvania. Love to fly you in if you're in Florida or one of the other areas. If you're in PA, New Jersey, please come out. And if you can't, jump on and watch the event live via live stream. And hope everybody has a phenomenal October. Thanks, everybody.